Do you want to discover how an ancient law can transform your financial future? Today, I present to you Gresham's Law, a powerful principle that will guide you to wealth and success. Gresham's Law is one of the most misunderstood economic and monetary concepts by both the general public and many economists. It was coined in the 16th century by the English economist Thomas Gresham. Its essence is simple but powerful. The popular interpretation of this law focuses on the economic sphere, especially in relation to the behavior of money and assets. This law, in its most commonly understood form, states that bad money drives out good money. This interpretation apparently contradicts market laws that govern other goods and services. In the market, a good or service is generally sold if it has higher quality or a lower price than the competition. Consumers' perception of quality is often decisive. Thus, it seems that Gresham's Law suggests that money is an exception to the general rules of the market. Letting the market decide which money prevails could lead to a situation where we always have the worst quality of money. In the financial context, this means that when two types of money, or monetary assets, with different intrinsic value are in circulation, people tend to use the lower value money for daily transactions, while holding on to the higher value money. In practical terms, this can be observed in many everyday situations. For example, if there are different types of coins or banknotes in circulation, such as some newer ones and some older or worn ones, people tend to use the oldest coins or banknotes first, worn out to pay, keeping the newer bills. That is, old bills will circulate much more than new ones. The historical concept of Gresham's Law and its practical implications have been studied for centuries. One of the best-known applications of this law was observed in the exchange rate between gold and silver coins. Throughout monetary history, we have seen that gold was preferred in prosperous regions, while silver predominated in relatively less developed areas. During the Roman Empire, gold was widely used as the main currency, coexisting with other forms of money. However, in the early centuries of the Middle Ages, a period of economic stagnation, silver gained popularity as a medium of exchange. But with the Renaissance and economic resurgence in Europe, the use of gold coins saw a significant increase in more prosperous regions. As industrialization progressed, gold established itself as the main form of money globally. Throughout these changes, both gold and silver alternated as the preferred monetary metals, although neither completely disappeared from the monetary scene. Gold, due to its high value per unit of weight, was used in large-scale transactions and long-distance trade, especially during times of commercial expansion such as in the Roman Empire. On the other hand, silver was more common in local exchanges and smaller-scale transactions, especially in periods where long-distance trade was limited, such as during feudal times. This alternation in the use of gold and silver over the centuries demonstrated that both metals retain their importance in monetary circulation. Thus, the dual system of use of different currencies implied that there were at least two monetary units in simultaneous use, which required part of the population to carry out conversions between different types of money according to the needs of exchange and commerce at each historical moment. This historical evolution illustrates how Gresham's Law influenced the preference for certain types of money depending on the economic and commercial conditions of each period. The problem arose when authorities attempted to artificially fix the exchange rate between gold and silver, rather than allowing it to be determined naturally in the market. The rulers wanted to establish a fixed exchange rate between both metals to simplify commercial exchanges and avoid the need to calculate the value in different currencies. The purpose behind this intervention was to prevent traders from facing risks related to fluctuations in exchange rates. In contemporary terms, this idea resembles arguments in favor of creating a single currency like the euro or even a global currency, seeking to reduce the risks associated with currency variations. However, reality showed that when the government tries to intervene to facilitate transactions, it often creates more complex problems. In this case, government intervention led to the aforementioned Gresham's Law. The attempt to fix an exchange rate between gold and silver usually initially reflected market conditions, but discrepancies soon arose. The relative value between gold and silver continually fluctuated due to supply and demand in the markets. For example, an increase in the wealth of the population drove demand for gold, increasing its price relative to silver. Likewise, the discovery of new gold mines increased supply and reduced its value compared to silver. These factors significantly influence the exchange relationship between gold and silver, generating constant movements in their relative prices. As can be seen in historical data, the relative value between these metals continually fluctuated between 10 and 15 times, defying attempts to fix an artificial exchange rate between the two. Before continuing, if you find this information valuable, I encourage you to subscribe to the channel. It's free, so you can continue enjoying more content like this. Let's move forward. So, when the monetary authority established a fixed exchange rate between gold and silver that differed from the market exchange rate, serious problems arose. To illustrate this point, let's consider the following example. Let's imagine that the authority sets an exchange rate of 10 silver coins for each gold coin of the same weight, but the market sets an exchange rate of 15 silver coins for each gold coin. In this scenario, the authority is indicating that the value of gold is considerably lower than its true value, and that the value of silver is much higher than it is actually worth. Under this 10-to-1 exchange rate policy, if the price of a commodity is 10 silver coins, the buyer faces two options: pay the 10 silver coins or pay with one gold coin. However, in the market, that gold coin is equivalent to 15 silver coins. Therefore, no one would want to exchange their gold coins, and most would prefer to use the silver coin. In this context, bad money refers to money that has a legal value greater than its real value, while good money is money whose real value is greater than its face value. It is understandable that people prefer to use money that retains its real value rather than that which has an inflated face value and is accepted for a fraction of its true value. This leads to good money being taken out of monetary circulation due to the problems caused by the artificial fixed exchange rate. The popular interpretation of Gresham's law has a significant impact on financial and economic decisions. People tend to prefer liquid and easily accessible assets, even if they offer a lower investment return, over less liquid but more profitable assets. In an inflationary economic environment, Gresham's law can lead people to invest in tangible assets such as gold or silver, which maintain their value compared to fiat currencies subject to devaluation. Thus, the popular interpretation of the law highlights how people tend to make economic and financial decisions based on the perception of value and risk of available assets. Understanding this law can be helpful in making informed and strategic decisions in managing personal finances and investing. But how can we apply this law to our personal finances? The answer lies in identifying and prioritizing high-quality financial assets that can generate wealth and withstand economic challenges. Let's see some practical strategies to apply the principles of this law in your investment decisions. Invest in quality assets such as gold and silver. Consider investing in precious metals such as gold and silver. These assets have historically been recognized as stores of value during times of economic uncertainty and can protect your wealth against inflation and currency devaluation. Real estate. Purchasing quality real estate properties, especially those located in areas with long-term appreciation potential, can offer stable passive income and a hedge against inflation. Profitable business. Invest in solid, profitable businesses that generate consistent cash flows. Look for business opportunities with competitive advantages and solid revenue models. Identify good assets versus bad assets. Evaluate intrinsic value of the assets in which you are considering investing. Prioritize those that maintain their real value over time and have sustainable growth potential. Analyze risk and return associated with each asset. Avoid those that have a high risk of depreciation or loss of value in adverse economic environments. Diversify your investment portfolio. By spreading your funds across a variety of assets, diversification helps reduce the overall risk of your portfolio by not over-relying on a single asset type or investment class. In short, by applying investment strategies that align with the principles of Gresham's law, you can protect your wealth and maximize the growth of your wealth in dynamic and changing economic environments. Always remember to look for quality assets. Diversify your portfolio and maintain a long-term perspective to achieve financial success. And you? Did you know the history of this ancient law? Tell me in the comments your opinion and if it has affected you in the daily life of your country. Thanks for watching the video. If you liked it, be sure to like it, subscribe to the channel, and share it with others who can also benefit from this knowledge. See you on the next video.